Welcome everyone to today's webinar on the Paycheck Protection Program. Here to kick off today's speaker and program, we have past NAIFA President Keith Gillies.
Yeah, thanks, Zach. It is with great pleasure that I get to introduce to you Murray Bradford, who will lead us today in a discussion presentation on the new PPP. I've wanted for a long time to get Murray to have an opportunity for him to fit into a schedule, a webinar like this for NAIFA. Murray has over 30 years of experience helping tax advisors, business owners, and others reduce their income taxes. In fact, he has a company called the Bradford Tax Institute. I invite everyone to go to that and to subscribe to his website. I am a subscriber, and I can tell you it's been valuable to me over the years to have this as a resource. He does put out a monthly newsletter called the Tax Reduction Letter, and he also provides information that you can provide to your clients. Today, you will learn what the new PPP money means for you and your business through an in-depth explanation of new PPP loans, rules, and forgiveness. Before we get started, I want to remind everyone to please type your questions into the chat box or in the Q&A section of the Zoom presentation. After Murray finishes, we will go through as many questions as possible and have Murray answer those questions for us. Again, I want to thank Murray for joining us today and welcome to the webinar. Mr. Bradford, the floor is yours.
Terrific. Thank you, Keith. And thanks for everyone for joining. Thanks, Zach, for helping make this work, and thanks to Brendan as well. So thanks to everyone. And so let's get started. The first thing is, of course, as you know, there's a brand new law. It passed on December 27. Well, it was enacted on December 27, passed on December 22. And this law, I know it's 5,000 pages and all that, but that's all irrelevant. What's relevant are the 200 pages that apply to the PPP. So on the PPP, what's happening here is, number one, we have new money that goes all the way back to the original CARES Act. In other words, if you didn't get loan number one, that's on the table for you. Number two, if you already have a loan, regardless of what status that's in, there is a way to get more money. And number three, there's a round two for those that got round one money. And for those that didn't get round one money, if you go get round money now, you can get round two money as well. So there's a lot of things on the table. Plus, there's the new employee retention credit that's available as well. So really, it's really well done. The idea of this whole thing is, I'm going to call it cash, but really the idea is to make sure all businesses can survive this pandemic. And so if you haven't gotten your money, you should get it. Because if I had to ask you this question right now, it has to be necessary to get it. Can you predict what's going to happen this year? Do you know how well your business is actually going to do? Well, if you do, then you're a mind reader, because no one else does. I don't. But so if you said, is that money less necessary? I would say absolutely. I can't think of any business where they couldn't say, I can predict how this year is going to turn out. So the new shot at the PPP cash, and the way the cash comes into you is based on your payroll. So let's talk about first timers first. So on this call, there are those of you that did not get round one for a couple different reasons, maybe, or didn't get all you were entitled to. So you can go back and get that, but the ones that didn't get it at all, here's how it works, are the ones that are getting round two. First of all, you go to your average monthly payroll. So let's use 2019. That's one of the years that's available. And let's say that your payroll was 90,000. You divide the 90,000 by 12 to get the average monthly payroll. You multiply by 2.5, presto, that's the money you get. There's no other formula to how much you get. The other part of the equation is what is forgiven. So, and you get to use 2019, but with the new law, you can also use 2020 or your trailing 12 months. And some are saying that you can even use the fiscal year. We haven't seen the fiscal year in writing, but we've seen the trailing 12 months. The new law also works, which is really interesting, for businesses that started in 2020 and didn't qualify for the other loan, but any business that was in business on February 15, 2020 qualifies. So one of the reasons that people did not get the money that they were entitled to is they were thinking in terms of the wrong four-letter word. So if I say to you, okay, we're talking PPP money, what is the four-letter word that's the wrong word? It's loan, right? So people were saying, I don't need a loan. I mean, for example, I had a copywriter. I had to tell this copywriter 5 times to get that money. Every time I told him, he said, I'm getting a loan. I'm not getting a loan. But he didn't tell me he wasn't getting a loan. He just said he wasn't going to get a loan. And that was the way he thought. And my Vistage chair was the same way. So people were thinking the wrong way on this thing because it's not a loan. It's a grant. It's from the government. It's tax-free. And you even get to deduct the expenses you pay. So the right four-letter word is grant or cash or help or insurance, a way of making sure that you can go forward with this. So who qualifies? Well, everybody qualifies. Let me start with Schedule C. So you're a Schedule C taxpayer. So you could be a single member LLC. You could be anything. You could be a statutory employee. Schedule C, you go to line 31. You have no employees. Based on your net profit from 2019, you take the net profit, divide by 12, multiply by 2.5, not to exceed 20,833. That's the amount of your loan. Now it's not a loan, right? That's the amount of your money. Schedule F. So I have to say, a ton of Schedule C taxpayers didn't get it. One reason was when this thing started, there was no guidance. And so a Schedule C taxpayer said, I don't have a payroll. The same was true of a partnership. A partnership with no employees says, I don't have a payroll. So they didn't put in for the money. Now they can. And by the way, when you put in for this money, you got to do it quickly. You know why? It's going to run out. Now the end game is March 31, but the sooner end game is when the money runs out. So the way it works is either when the money runs out or March 31. Now maybe they'll put new money in. We don't know anything that's going to happen in the future, but the bottom line is right now, today, if you have not gotten your loan, you need to go get it. Schedule F, big change there. These are the farmers. The farmers, when they went to net income, that was, way down there, and maybe they didn't have any net income, but maybe they had gross income. The new law changes it not to net income, to gross income. So farmers have a new shot, they have a bigger shot. Gross income is simply you take revenue, subtract the cost of sales, presto, you got gross income. And then you got all your operating expenses and stuff like that below that. Partnerships, you take the self-employment income of the partners. The partnership's the one that has to qualify. I mean, it has to apply. And so the partnership gets the money. And then it gives the money to the partner. So you got to pay this money out. So the Schedule C taxpayer, what they want to do is they get the money, they put it in their bank account, and then they take it out and put it in their personal account. So that's called paid. So the same would be true of the partnership. Partnership gets the money. They want to distribute it out to the partners. And then if the partnership needs the money back, no problem, they can reinvest it. So S corporation, one shareholder employee, interesting things happen here. So for those that are S corps and have no employees, the next question is how much is your salary, right? Because the savings with the S corp are to cut the self-employment taxes. So that means you want low salary. Well, low salary means a low PPP. But some people have a salary of 0, which number 1 is wrong, according to law. And number 2, If they have zero, they can't get the PPP, zero with no employees. C corporation, pretty straightforward. And by the way, these equations, the way it works, you actually get more, the payroll. So the payroll for a Schedule C taxpayer is just the profit, right? For the partnership, it's the self-employment income of the partners, which comes from the K1s. But for the C corporation, the C corporation is, and the S corp, they actually get a little more money. S corp gets to use the payroll plus the retirement plan. And payroll, by the way, for an S corp includes the medical insurance, right? You put that on the W-2 in box 1. And then the C corporation, they get to use both the medical fringe and the retirement fringe. Add that to the W-2 to get the amount. And then when you go to the employees, you can't have, in round 1, you got to have fewer than 500. But the employees basically is the W-2 salary plus the fringes. And I mean, most of the fringes, I mean, when I say fringes, the medical fringe, they can get group life now, that's a retroactive, and retirement, et cetera. So there's a bigger number for them. But remember, it's all based on the payroll. So you get to that payroll number and then you move forward. So the new law has all good news, really. And this was a problem with the old law. So number 1, the new law confirms what we all knew. The PP money is tax-free. So number 1, you get it. You don't pay taxes on it. Number 2, this is new. The new law authorizes the tax deductions for expenses paid with the PP money that's forgiven are deductible. Now note that's the money that was used. And by the way, if you get the loan, you want the whole loan forgiven, right? 100%. So if it's all forgiven, then that means, and you can only get it forgiven if you paid the expenses that were authorized by the PPP money. So bottom line is you're going to be able to deduct the expenses. So best of both worlds there. Now, where would you go to get this money? Okay, this is another problem. I can't tell you how many people went to their bank. So a person, Schedule C taxpayer, for example, goes to the bank. The bank says, you don't have a business account, we're not going to give you the loan. And they don't. So that person, that taxpayer, right, says, I'm out of luck. But they're not. The bank is wrong. If they then go to Cabbage, which I'll tell you the Cabbage story, if they go to Cabbage, they'll get the loan. So true story, one of my proofreaders, self-employed, he goes to his bank. The bank says, you can't do it with us because you don't have a business account. So he says, what do I do? Well, first of all, he said, no, I can't get it. That's what he tells me. That's what are you talking about? He tells me what the bank said. I said, well, that's garbage. I said, go to somebody that understands the game. So he said, who should I go to? I said, go to Cabbage. So he goes to Cabbage and Cabbage gives him the loan. He gets the loan like in 5 days. And the bottom line is it doesn't matter what type of account you've got. You just have to be in business. You're in business if you file a Schedule C, period, right? The Cabbage story, let me tell you, Cabbage is actually not doing round 1 loans anymore. They were bought by American Express, so they're now into a new game. And but the Cabbage story, I can't tell you how many people we sent to Cabbage. And the reason we sent them to Cabbage, in fact, I went to Cabbage myself. I'll tell you my Cabbage story. First of all, I bank with B of A, Bank of America. Bank of America was useless on the PPP. I went to their website. Oh my gosh, I said, this is just ridiculous. And I already knew about Cabbage. So I went to Cabbage and we applied on a Monday. My bookkeeper did it. Took her about 45 minutes. And we had the money on Thursday in the bank account. Lendio is another one. Now, so Cabbage, like I say, is not doing it right now, but there's a lot of them out there that are. So Lendio, for example, we did with Lendio for one of the companies we have. And with Lendio, they refer to other lenders. So Lendio does the processing and then they refer to the other lenders and then you get the money. So our Lendio experience wasn't near as good as Cabbage, but 2.5 weeks, we had the money in. We had the authorization for the money. We didn't take the money from them. Instead, we took the money from NAV And the reason, well, no, we took the cabbage money instead of the Lendio money. The NAV money, so NAV is another, so these two, Lendio.com, let me go back. Lendio, they refer to other lenders. So you fill out the application with them and then presto, it goes to the lenders. NAV's the same thing. NAV, we started an application with NAV and my bookkeeper did this as well. And so she's filling it out. And as she's doing it, boom, here we get the application with the bank. And we're actually dealing with this, I think it's called First Home Bank in St. Petersburg, Florida. We're in California, right? And so there it is. The money's on its way. So your strategy is this. Number one, first, go to your existing bank. Second, go to apply with another one. Apply with one of these online things, whatever. Have more, in other words, you want more than one lending application out there, more than one. Okay, I want the money and get more than one of those in play. And just take the first one. There's no penalty for not taking the other guy. So the slow guy loses. And they get paid, by the way, pretty well for this type of stuff that lenders do. So let's switch gears. So we just talked about the getting the loan, right? Now you also now have a strategy, a new strategy regarding the payroll. So to get for full forgiveness, you have to spend 100% or 60%, I'm sorry, you have to spend 100% of the money, but 60% of the money has to be spent on payroll. The other 40% on other authorized expenses, which have been expanded by the new law. So if you get 60% on payroll, you're going to get 100%, assuming you don't have a drop in headcount or a drop in pay greater than 25% for an individual employee. So, but there's a new strategy on the street right now because of the new law, and it comes from the employee retention credit. So the employee retention credit is a 50% credit on up to 10,000 of wages paid in 2019, and it's a 70% credit on up to 10,000 of wages paid in 2020. So you have to qualify for it. We'll talk about that. That's very easy, frankly. And but this employee retention credit now is in play for last year for people who already got their PPP. Now, a lot of people, when they looked at this whole thing, when it started, they said, okay, I don't think I'm going to get the PPP. I'm just going to go for the employee retention credit. But what's shocking to me is there's tons of people out there who didn't get the employee retention credit. I went to a webinar put on by one of the top 25 accounting firms, and they gave us 3 case studies. And in all 3 studies, these were larger companies. But imagine this company has got 200 employees. They don't get they don't go and get the employee retention credit. They don't. I'm going to myself, hold it. Where's their bookkeeping department? Where's their controller? What's going on? Anyway, they didn't get it. So this CPA firm goes and finds them $100,000 just laying on the table that they could have gotten had they known the tax law or known the employee retention credit, which is the tax law. So that actually happens through the payroll system. But the beauty of this employee retention credit is it may apply to loans already forgiven. Let me give you an example. Let's say, could make you bigger right now so let's say you got a PPP loan of $1 million and that you had a payroll that you put on the form for forgiveness of $1.5 million. So you put $1.5 million that money's paid, and you put that on the payroll, but you only got a loan for $1 million. So, and used $1.5 million for payroll, right? So can you then say, okay, that other $500,000 applies to the employee retention credit? I can get that employee retention credit for last year, even though I was already forgiven. And my answer is yes. The AICPA worries about that a little bit. They sent a note off to the congressional people asking them to clarify that you could do that. But the bottom line is, you spent the whole thing on the 60%. Or let's say you got the $1 million and 60% was for payroll, the other 40% for the other expenses, same thing, you still have that payroll that would qualify. So the bottom line is you could have payroll out there, even on loans already forgiven. Loans that are outstanding. So let's say you've got a loan that is outstanding and it's actually at the lender's got it. So you want to go get that back, right? So, but loans outstanding for sure, you could manipulate those for the employee retention credit. New loans for sure as well, and round 2 loans. So all of those qualify. So when you think of the non-payroll costs, think 40%. So to get full forgiveness, you got to spend 60% on payroll, 40% on the other expenses, or you can, 60% gives you full forgiveness. You can spend the other 40% on the rest. Now, if you're a Schedule C taxpayer, you just spend it on yourself. Forget it. This is like easy peasy. You get the loan, say 20,000, and they give you the loan, goes to your bank account, you pluck it out of your bank account to yourself, your money now, and you do with it what you want. That's the end of the game. You want to make sure you move the money like that, though, because the form says paid. We don't know what they mean by that, but it certainly means that the money should move. So you want to make sure you do that. So the non-payroll costs, this is where you can spend the 40%. So we get a loan and we're going to spend so much on the payroll. And before the new law, the other authorized expenditures were for rent, utilities, and mortgage interest. The new law expanded this list retroactively to all of last year, all of 2019, to include operating expenditures, property damages costs, supplier costs, worker protection expenditures. You all have, I think, like a PDF of this presentation. And in that PDF is a supplement. In the supplement, all of these things are explained in detail. Actually, they just give you what the code says because that's all we had at the time. But the good news is the new additions here make this far easier to work with. So life is much easier. So let me just move this piece of paper out of the way here. All right. So let's talk about draw 1. So that was what happened in 2019. Remember that draw 1 ended on August 8, 2019. And that was just an end date. There was still like $300 billion in there. And by the way, the new authorization is no greater than what the money was already left over from draw 1. So it's not like they just threw a bunch of new money at this. This was draw 1 money already. But let's say draw 1 PPP money is already forgiven. I mentioned this briefly just a minute ago. So the new law is granting reversal of the emergency injury. So there's 2 things that are happening here. So we got the money last year already forgiven. Now we get the new law. The new law is going to give us cash in 2 ways, possibly cash in 2 ways. One way, more than just depends. One way is the idle advance. So what is an idle advance? An idle, if you apply for an idle, that's an emergency injury disaster loan, which a lot of people did when this law came out, you automatically got an idle advance. It was automatic. So you get the idle advance, and then when you went to get forgiveness, they subtracted the advance from your forgiveness. So you really got the full PPP, you got the full benefit of that, but the idle advance was a reduction in that. If you didn't get a PPP, the idle advance was simply tax-free. And the expenses paid with it, by the way, are deductible. Now, with the new law, they reversed the idle thing and said, okay, the idle advance should not have reduced. We didn't want it to reverse the PPP. So SBA, please process refund checks for those people. And the regulations for those have already come out, and they're in the process of doing that. So if you received an EIDL advance last year, you can expect a check for that amount to show up within, who knows how long that'll be, but you're going to show up soon. And then you've got the retroactive employee retention credit. And this is also good news, as I mentioned. And I did mention the AICPA memo, which was of concern that if the loan had already been forgiven and those expenses were reported with the loan amount, even though not used for that purpose, that those would not qualify for the ERC. They didn't want that to happen. Now, here's my take on that. I'm going for it. I'm going to get that employee retention credit if I qualify. And if I'm paranoid, I will put in a tax return a statement that here's why I'm doing this and what I base it on. And so to avoid penalties for myself and if I was doing it for a client, for the client. But the bottom line is, with this new law, we now have more free money. I mean, right. Now, if the loan is not yet forgiven, but the forgiveness application is with the lender. So if the lender's got it, you've applied for forgiveness, and you would qualify for the ERC, Employment Retention Credit. So it's with the lender. Go grab it, get it, rescind it, whatever you got to do to get it back so you can modify it and get both benefits. If you haven't applied for forgiveness yet, relax. You're in the driver's seat. So how do you qualify for this employee retention credit? And the answer is, well, number one, if a government order fully or partially suspended your operations during a calendar quarter due to COVID, you're in. Well, let me ask you a question. Where do you live that this did not happen? Right? I'm fully or partially suspended your operations. Stay-at-home orders, right? I mean, we just got out of one here in Northern California. So the stay-at-home orders obviously shut down a ton of businesses. The car repair services were still open. Gas stations were still open. But they were certainly, everybody else was pretty affected. Or the second choice, so this choice one, that a government order, local, state, anyone, partially or fully suspended your operations during a quarter, or your gross receipts for a calendar quarter are less than 50% of the gross receipts for the same quarter in 2019. So you really suffered. If this is the case, then your employee retention credit is 50% for that quarter, and you continue that until your gross receipts exceed 80%. So it depends really a little bit on how much you're paying the person, right? So you remember, it's on a quarterly basis. It's a credit of 50% up to 10,000. So if you were paying the employee 10,000 a quarter, 40,000 a year, obviously that would work for one quarter. But here you would have 2 quarters, right? If you get 1 quarter, more than likely you're going to get 2 quarters. So that's all going to pay off. And there's also new Happy Days rules for the employee retention credit. The big deal is you can benefit from both the PPP and the employee retention credit, not just on the same wages, but up to 50. So that means that the PPP is one set. You have to look at that separate. And then you look at the employee retention credit possibility. That's got to be paid with different money. And up to $5,000 per employee in 2020 and $14,000 in 2021. So in 2020, well, the rules are the same. So the tax credit is on wages of up to $10,000. And the credit is 50% in 2020 and 70% in 2021. So big change, 2021, you can qualify for up to $14,000, whereas in 2020, the most you could get was $5,000. Now, the way the credit works, if you have 100 or fewer 2019 employees, all the wages qualify. If you have more than 100, then only the wages paid to workers who were not in the shop, they were not working, and you were paying them anyway. So that's the way that would work. So a retention credit. In 2021, the 100 goes to 500 and all wages qualify. So a great simplification here. This one here, you had to do, you had to look at what was going on, because a lot of people say they would furlough the employee, but maybe they'd still pay the medical expense. Well, the medical expense counts as wages, so that would trigger the credit. And so there were different ways to get the credit for sure. All right, well, let's look at round number 2. This is technically a second draw. And to get the second draw, you had to have a first draw loan. And then, according to the law, you have to have used it, has to be used already, or be set to be used soon. So what does that really mean? Well, it means that on the first draw, you got the money and you've already applied for forgiveness or you're in the process. Or I got this thing from this home loan bank yesterday. And what they say about that particular rule is, now listen to this carefully, says must use or commit to using all of the first PP money loan received. So what this bank is saying, and remember, they're the ones that give you the money, what it's saying that you either used it or you got to commit to using it. Well, who's not going to commit to using it? Of course, you're going to use it. Because otherwise, it's not going to be forgiven. You got to pay it back, right? Now, even that's not a bad thing, because remember, the interest rate on this PPP money is only 1%. So where are you going to go get a 1% loan? You're not. I mean, this is the cheapest money ever. Now, to qualify for round 2, there's a difference between round 1. Round 1 was 500 employees. Round 2 is 300 or fewer employees. And then you had to have suffered a 25% or greater loss in revenue during at least 1 quarter of 2020 when compared to 2019. So this is a quarter by quarter thing, and it's a calendar quarter. So they just clarified that calendar quarter with some new regulations that came out recently. In fact, well, here's what happened. The law passed, like I said, enacted on December 27. And then the SBA was instructed to come out with these, you'll love this word, interim final rules, or their idea of regulations, but they call them interim final rules. You got to be kidding me. What do you mean? Is it final? Is it just interim? In tax law, we have proposed and temporary and regular, right? They got 3 types. Temporary, for the most part, these days means that's going to end up being regular. In the old days, a temporary was actually believe it or not, a temporary reg was a final reg. It just didn't have to have the same review process. So you'll have some of the older regs that will use the word temporary, but it's really a final reg, just to confuse us. So the round 2 cash, the way it works, same formula, now this, remember, this is the cash inflow. 2 times the average monthly payroll. For example, you got a 2019 payroll, say of 90,000, just like before. Divide by 12, multiply by 2.5, 18.750 would be your loan. You can use for the payroll right now, 2019, 2020, or the trailing 12 months, whichever would give you the most money. Now, the problem with 2020, it's Schedule C, right? And so your Schedule C is going to be the determinant. And the question is, have you filed it or not? And if you have not yet filed it, then how accurate is it going to be? One interesting thing, I got something from a woman yesterday. The lender asked her to submit her IRS transcript of her 2019 return. When she applied for the loan, she had used the 2019 Schedule C estimate, right? Because remember, this whole thing happened in March. She hadn't filed her tax return yet. Her accountants and everybody else were closed down. They didn't even go to the office for a while. So she couldn't file. So she just did the best she could. She created it. Well, that number is $8,000 different than what's on the 2019 form that she submitted. You know, to me, no big deal. But what the lender said is, look, you're not getting any, we're not forgiving anything because you submitted an inaccurate 2019 Schedule C. So I don't know how that's going to turn out. And we haven't done battle with that in the past. So I got to ask some of my people that are true experts in this area and do this all the time, you know, how they would handle that and whether they think it could work. If you're in the restaurant or hotel business right now, for round 2, you multiply by 3.5 instead of 2.5. So you get more money in round 2 than you would have gotten in round 1. So now we've got the forms, right? So the beauty of the forms are all new. I don't know if that's a beauty or a beast, but they've all been revised because there's new elements that enter into each one. And they were revised on January 19, so just like last week or so. And we've got 3 forms that you're going to actually consider, right? So let's start with the new form, the 3508S. Now the 3508S used to be for 50,000 or loans of 50,000 or less. Now it's for loans of 150,000 or less, and it applies to rounds 1 and 2. So the big deal of this form, the S stands for simple, which I would define it as stupid. And the reason I say that is because you can file this form without saying what's going on. So did you qualify, not qualify? You can just qualify and say, yeah, I qualified. The problem with that is, did you really qualify? And if you were to get audited, would you have a problem with it? And then in these audits, we don't know how they're actually going to work. You know, a big deal before was how many people are committing fraud on this thing and so on. That might be what's happening to that woman that got the Schedule C thing, right? She's got that problem. So I don't like that form. I mean, it's certainly easier to use, but you still have to comply with all laws. There's not a single change in the law. I really like the 3508EZ. Now you can use this only if you have no reduction in headcount or no reduction in pay greater than 25% for an individual employee. And this 3508EZ works for both rounds 1 and 2. The forms, you know, you look at the form, any government form, like a tax return, right? They're all intimidating at first, but then once you dig into it and so on, not so bad. I think this EZ is a pretty straightforward form, easy to use. And the thing I like about it is it does address all the things that are necessary to get the loan forgiven. So unlike the S just says, put the number down there, we're going to forgive it. And then the 3508, that's the full thing. This is the full-blown form. And it's 5 pages. I just printed it out this morning just to see what was going on with it. That's the same thing as before. And you're just attesting to the different things. And if you have any change in headcount or pay, you put that on there. And I'm not going to go into those things today, but and I'm not expert on all of the things that you can do with that. But you know, I know that that's available on the headcount and so on. So, but the 3508 is a way to assure yourself, yes, I'm really getting this the way I want. And then there's a 3508D, that's a new form now. And this is the borrower's disclosure of certain controlling interests. So if you own more than one business, then you would complete this 3508D. And the rules on those businesses are different now than they were before. I mean, they are for round 2 and for new initial loans, because you remember the employee, well, you look, okay, the way I want to say this, I guess, is they're looking at people like they have more than one location or they have more than one corporation, and they want to look at that. By the way, if you own more than one business, let's say you own three, well, let's use this example. Say you are a statutory employee and you also have securities income. So you got two Schedule Cs. You can get the loan on each Schedule C, but the loan amount cannot exceed $20,833 in total. And if it does, then you can't apply, you can't get forgiveness on both those amounts. You'd have to pay back some of the money. So these forms, the application forms, applying forms, were revised on January 8, 2021. So again, everything new in January. Now, here's a term, and this is on all the forms, and this is a big term, and what people really worry about is the loan necessary? And I know I started the program by saying, can you really tell me that in 2021, your business is not going to be affected by COVID-19? If you can and say, yeah, I don't need the money, fine, then you don't. But if you say, I'm not sure, then the loan is necessary, right? So I think necessary is really relevant for most people. And the second thing is, this is tax money coming back to you, and don't worry, you're going to pay it back eventually. That's the way the game works, right? So I wouldn't feel guilty personally. So round one, form 2483. Now, and then I put, but it's really, so yes, form 2483 is the SBA and Treasury Department's form. But you don't go to them to get the loan. You go to the lender. And the lender often has its own version of a form that includes things they want to know or things they want to do. Or they don't have the brightest bulbs in the planet. They're helping create the form. Bottom line is those forms can vary from the SBA form. Now, if that's true, then the question is, how is that going to work for getting the money? And, I can tell you for sure in one of the loans we got, the form, they gave us a lot more money than we would have been entitled to with the form. So it's just there. And you can use it, right, for the payroll and these other things. So as long as you use it, that's not a problem. We did. So for us, it worked out. We're going to get full forgiveness, even though we didn't qualify for that much in the beginning. Crazy. It's crazy. And then form 2484 SD means second draw. So that's a new form. And again, that's the one with the quarterly thing. And that's also got the necessary element in it as well. But what I'm really trying to say in this element is, look, don't worry about that element thing. I mean, it's just not something to worry about. Okay, let's do a couple takeaways here. First takeaway is what? The word loan is not true. It's really PPP monies. If you qualify, obtain the PPP monies. Number two, if you have the employee retention credit available and you've not taken it, you can go back and get it from 2019. And then number three is if you already have a loan outstanding, you've got ways to get the employee retention credit from that you didn't have otherwise. So you want to make sure you do that. And then lastly, we have the employee retention credit. We want to make sure that we get that as well. So with that, Keith, are you about ready? We're at the questions and answers.
Yes, Murray, thank you. Thank you very much. We do have some questions. A lot of people on the call may be statutory employees. Will a statutory employee qualify for this round of PPP?
So let me ask you a question right back, Keith. What tax form does the statutory employee complete?
Schedule C.
Schedule C, right. So the statutory employee qualifies, goes down to line 31. That's the net profit. That's what's used in the application. do that today, because what's going to happen next? The cash is going to run out.
Right. Also for Schedule C employees, if they have employees, but they end up with the Schedule C loss, will they qualify for PPP this round?
Yes, yes.
Okay.
So what happens is the owner part is based on the Schedule C. So we didn't pay the owner at all. But we did pay other employees. Let's say we had 4 of those, and let's just say we paid each of them 40,000. That's 160,000. That would be the number you would divide by 12, multiply by 2.5. That would be your loan amount, even though you had a loss in Schedule C.
Okay, great. I think you answered this earlier. You mentioned it earlier, particularly about someone who is a sole owner of an S corp but doesn't take any salary for the owner. They could qualify, correct, for their employees, but not for themselves.
Correct. Yeah, on their situation for themselves, they get nothing. But for the employees that got W-2 income, they would all qualify. I mean, not they would qualify, but you would qualify as a business to get it to them.
Right. So the question regarding forgiveness, do you file that form with your bank or directly with another government organization like the SBA?
Yeah, the way it works, you file with the lender. The lender will have their version of the forgiveness thing, and it includes some of these documents that you have to send to them with that. And then they're supposed to, I don't know exactly what they're really doing, but they're supposed to then say, yeah, we have your application and we're forgiving your loan, and we are submitting the forgiveness application to the SBA for final approval. So that's the way the statute kind of reads and the way things, but I'm not sure how the lenders are dealing with that, whether they wait for the SBA to say, yeah, it's forgiven. So that I don't know for sure.
Okay.
But either way, you send the forgiveness application to the bank, and then the bank is the one that handles it from there.
Do you know if Schedule C sole proprietors are limited still to 100,000 of income?
Yes.
Still limited to 100,000 of income. Okay.
Right. Yeah. So it's 100,000 divided by 12, multiplied by 2.5, which means the maximum is 20,833 for a Schedule C taxpayer.
Great. And we have some really, really good questions. I'm trying to get through these quickly so we can get you to answer all of these. If an individual applied for and used round 1 in 2020, has not applied for forgiveness, but had a 25% loss in a quarter, can they apply for ERC?
Well, the 25% in the quarter allows them to apply for a round 2 loan.
Okay.
For the first part of that question on getting the ERC, to get the ERC, you compare the 2020 quarter with 2019. Well, and you got to have a 50% loss. But the real deal is, was your business adversely affected by a shutdown?
Which you have said is, it's hard to find someone in the country who was not under some type of shutdown order.
Right, right. I mean, when it happened here, for example, when we first got this whole deal, like the accounting firms on first floor and the lower level, all their employees started working at home. Well, that's obviously disruption, right? I mean,
correct.
You have their computers in the office, blah, 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 how are you setting them up at home and so on. So yeah, I think most people got affected.
Yeah, this is something that may be outside of your wheelhouse, but if somebody applies for a PPP loan and received it, do you know how the banks are looking at that if they're applying for other business loans? Is that taken into account? Or what have you seen?
Well, I'll give you one example from, I'm going to stop sharing my screen so you can I'll be there. Yeah, so let me go to, I'll give an example. This woman applies. See, when you apply for like an idle loan, that's with the SBA. The banks don't have that information. With a PPP, you don't have to submit anything else in the PPP stuff, right? So the bank doesn't know, is not supposed to even know anything about the PPP. So you can get both, and a lot of people did. So I'm gonna tell you the story of this woman. So this woman applies for the PPP, first of all, for the EIDL. She gets 6,000 on the EIDL because she's got 6 employees. She applies for the PPP. On the PPP, she gets 39,000. Then a few months later, she gets 96,000 from the SBA on the EIDL loan. All this money magically appears in her bank account, right? And frankly, she don't have a clue what's going on. And so her question was, what do I do? Well, the answer is, number one, don't use the PPP money on the EIDL loan, because on the EIDL loan, and why you wouldn't know this, but you've signed that you're going to use it specifically for these things. And if you violate those rules, you're violating the statute and subject to big fines. So the deal is, if you got both of those, you use the EIDL one way and you use the PPP a different way.
Okay. This is a more complicated question, and I'll read it directly. I merged my business with my new partner into his existing business in November of 2019. Our business is off from first quarter 2020, but because we kept his tax ID number and added to my business to our numbers, look like they're higher in 2019, but are only showing as 2019 production. You have any idea any recommendations for this member?
You know what, Keith, read that one more time.
Yeah, it's basically what I think happened is we had 2 businesses. They merged into a partnership in 2019, but kept partner A's tax ID number. And then in 2020, that tax ID number, they had a loss of 25%. But when they add both numbers, do they then add both partners' numbers together for the new business, even though they were separated in 2019?
Yeah, that's a good question. Number one, so in 2020, you're saying they're a partnership, but in 2019, they were individuals.
Yes. I think that's a simpler way to ask the question.
Okay. So they're going to get the loan based on the partner's self-employment income in 2019. Now, they don't have that, right? Because it didn't exist.
Correct.
But they got the loan, right?
Yes.
Okay, so now you got the money. That's step one. You always want to have the money. Possession, 9/10 of the law, right? So now we got the money, and the forgiveness is going to be based on the partnership return.
Right.
Right. So actually, in this case, you know what? I don't think there's any new submission for a partnership when they go to get forgiveness for the partners. Because remember, the loan was based on the partner's self-employment income. So whatever it's a mess.
Yeah, I guess let me see if I can restate this. What governs this is the tax ID number of the business. Would that be fair to look year over year?
I'm not, I wouldn't say that's for sure.
Okay. All right. Well, that's beyond us.
I just want to, let me just look here. I got the form right in front of me. Yeah. So
I'll tell you what,
you're
we'll
going to
get to some of these. Maybe we'll try to get these questions outlined, and that was a more complex question. Let me ask you about Schedule F. So we've got some farmers out there. Are farmers eligible if they don't have employees?
Yes, absolutely.
Okay.
And it's based on gross profit, which is line 9, I believe, of Schedule F.
Of Schedule F. Okay. All right. Do you know how the second loan will be forgiven as an owner with no employees?
Same way as the first.
Same as the first one, okay.
Yep.
Great, all right, let's see. If you maxed out round one, there is still money for you in round two, correct?
Correct.
Okay. Round two.
And remember, all this money, don't let any grass grow under your feet, because this money disappears. I can't emphasize that enough. March 31 for sure. And also when it runs out. So, you know, a lot of people got hung up at August 8th, even though they knew about that was going to be the ending time, but you got to go to the lender, you got to get approval, right? So it's got to go to the SBA, they got to get approval. That approval had to happen on August 8th or before.
Okay. Yeah, we've had several comments about this is an excellent program. So I just want you to, last question, can you clarify these forms for us again, the distinction, the 2484 SD 3508S?
So the 3508S is a form that can be used by any business that's the loan was 150,000 or less. It's a simplified version. Doesn't simplify any rules. It just simplifies the way you submit the form. So let's say this form, you can complete it in, I'm just using a number, half an hour. The other longer form would take you an hour.
Okay.
So I would go with the longer forms. And the reason I would do that is because then I know I've dotted the I's, crossed the T's, and I've done everything I need to do. The problem I have with that easier form is you just get to put in, the only number you got to put in there is, yep, here's the amount to forgive.
Right. So that way you're on record, you've submitted the document. If it gets approved with the long form, you can feel pretty good that you're in good shape.
Exactly. Yeah. Anybody showed up, you got the form, you got all the evidences there. The other thing is, say you do the short form and you just kind of wing it. And now 2 years later, somebody's asking about it. How are you going to dig that stuff up? It's going to take you hours and hours. It's going to take you 25 hours.
Got it. Well, Murray, I want to tell you, you were outstanding today. I want to remind everybody, Murray does have an outstanding resource for you, the Bradford Tax Institute. I invite you to go take a look at it. Again, I'm a subscriber. It's been incredibly helpful for me. And thank you, NAFA, back in our headquarters, wherever you are scattered all across the country, for pulling this together for me. And again, Murray, great thanks to you, my friend. You did a wonderful job.
Terrific. Thanks, Keith. Thanks for having me. My pleasure.
Good afternoon, everyone.
Thank you, Keith, and huge thank you to Murray for all your expertise and insight today. For those of you who joined us, a recording of today's session will be made available. So thank you again, and we hope to see you again soon. Have a great day.